Hello, I'm Lelda Smits for the Capital Network, and joining me here in Sydney at Commsec is its Chief Economist, Craig James. Craig, terrific to speak with you today.
It's certainly good to be here with you.
Now, if we can look at the Australian share market, the S&P ASX 300 index lost about 2% in 2015. Where do you see the benchmark index trading this year, and what are the driving factors behind that forecast?
Well, I think it's going to struggle over the next couple of months, and global share markets are struggling at the moment, worrying about oil prices, worrying about where the United States economy is going, where China's going. But we do expect it to struggle over the next couple of months and then start improving. And if we look at the ASX 200, we're looking at 5,200 points by mid-year, 5,500 points by the end of the year. So certainly gathering pace as we get towards the end of the year. I think the other important thing to stress is that while the overall growth of the share market may be a little bit restrained, we think the dividends will continue to be paid. And you factor in dividend yields around about sort of 4.5%. Total yields on shares should be pretty healthy over 2016.
Well, it's nice to have a bit of optimism there, but you mentioned struggle. The Aussie dollar certainly knew all about that last year, plunging about 11% against the greenback. Where do you see that trending this year, and what kind of sectors are likely to benefit?
Well, if anything, that Aussie dollar is probably going to struggle even further over 2016. We're looking at around about 65 cents by March. That's provided that the Federal Reserve continues to lift interest rates. They may delay lifting interest rates, and that means the weakness of the Aussie dollar may move towards the mid-year. But by the end of this year, we're looking at the Aussie dollar picking up to broadly where it is now, around about 69, 70 cents, getting to those sorts of levels. Clearly, it's the exporter sectors, the mining, the resource type areas that are likely to do well, be insulated by that lower Aussie dollar coming down. Got to be remembering that commodity prices are going to be weak, so it's really that resource sector, so we'll be getting a degree of support from a weaker Aussie dollar.
Over in the US, we saw US stocks record their worst annual performance since 2008. Do you believe that there may be an improvement this year, or are you still feeling bearish?
Well, I think there will be an improvement this year, but it's got to be remembered that the US share market has been overvalued and probably still is overvalued by around about 10 to 15%. So it may struggle just like the Australian share market over the next couple of months. But as we go through the year, what we're going to see is the US economy continuing to blossom. We do know unemployment's low. We know that the housing market is picking up. And I think as we move through 2016 and some of the risks are dissipated, then we're going to see that share market brighten. So looking at the Standard & Poor's 500, we're looking at 2,100 points by the end of the year, which would be fairly useful sort of growth, something in the order of 10% growth for the US share market, but much more of those gains in the second half of the year rather than the first half of the year.
Okay, so with that improving and brighter, hopefully, outlook by the end of this year, how does that impact what you believe the US Federal Reserve and the RBA will do in regards to monetary policy?
Well, for the Reserve Bank, I think it's a fairly simple equation. Our economy doing quite well and probably going to gather a little bit of pace as we move through 2016. For the US Federal Reserve, they're probably going to have a degree of caution early on in the year about lifting interest rates. But as some of the risks dissipate about China and about oil, we will see the US start to normalise interest rates a little bit more than what they've done. We're looking probably at 2 or 3 interest rate hikes from the US Federal Reserve, and most of those concentrated in the second half of the year.
Okay, and the RBA, where do you think we'll see the key cash rate end 2016?
Well, we think the cash rate is not going to change over 2016. We just think there's a nice balance involving at the moment. Unemployment's coming down, housing market's becoming more balanced between demand and supply, inflation's under control. Simply, there's no reason why the Reserve Bank would need to be increasing rates at the moment or cutting interest rates. And I think that's probably going to remain the case as we go through the entire year of 2016.
Wonderful. Well, Craig James, always wonderful to hear your predictions and outlooks, and all the best for the year ahead.
Thank you very much.